Today we'll talk about funding a whole life insurance policy with a lump sum of money, and we'll focus on doing this with a 10/90 split, meaning of our ongoing payment, 10% is dedicated toward the base premium and 90% is dedicated toward the PUA rider. So the specific question that we're going to answer is as follows. Can I have a whole life insurance policy where I fund $20,000 per year, I have a base premium of $2,000, a PUA payment of $18,000. That's my 10/90 split because of the $20,000, 10% is directed toward the base premium and 90% toward the PUA. And then on top of that, in the first year, can I add an additional $100,000 lump sum to my PUA rider? So we'll answer that specific question and we'll look at several models today, and we'll also measure the efficiency of the cash value growth. First, let's hit on a few terms that are important to be aware of. If you're getting a whole life insurance policy and cash value is the goal, there are three main terms that you want to be aware of with a whole life insurance policy. The first is your base premium. The base premium is required with all whole life insurance policies. I like to refer to this as the initial insurance expense because money I pay toward the base premium will prioritize life insurance first and cash value second. Meaning, if we look at a traditional whole life insurance policy that has a $1,000 annual base premium, you will see zero in cash value in the first year, or very close to zero. If that base premium was $10,000, you would see zero in cash value in the first year. The same is true if that base premium is $100,000. The base premium prioritizes life insurance first. Then we have our paid up additions rider. Money we pay toward this rider prioritizes cash value first and life insurance second. I like to refer to the PUA rider as a cash dumping. If I take that same traditional whole life insurance policy and pay the same $1,000, I'm going to see somewhere between $900 and $1,000 show up in cash value in the first year. It will depend on the company and product, as many companies and products do have PUA fees, so I won't see all of my PUA payment show up in cash value in the first year. Now, the last term is very important. It is referred to as a term insurance rider, and what this is a low-cost method to raise the death benefit of my policy, which if I said I don't care about the death benefit, the purpose is it raises my MEC limit. So why people are often attracted to cash value life insurance is because the cash value is a safe place I can put money, I can access it anytime without penalties, and it has a unique loan feature, and if I follow IRS rules, I can access that money tax-free. One way to mess up the tax-free benefit is by triggering what is called a modified endowment contract, or a MEC. How we prevent this from occurring, though, is by not funding more money than whatever my MEC limit is. So we can set the MEC limit wherever we want, and the most cost-effective way to do this is with a term insurance rider. So what you'll see when we're designing a policy is that a term rider allows you to reduce your base premium and then add more money into PUAs without triggering a modified endowment contract. And you'll see that as we go through the models. So, how do I get the most cash value in any whole life insurance policy? And again, we're going to be focusing on this specific case design. So, assume you want to fund $20,000 per year. Here's exactly what I would do. I would minimize the base premium as low as the insurance company will allow, which in many cases is 10%, so $2,000. Why I would do that is because by reducing the base premium, I reduce the upfront hit I take on cash value. Then I would add a term rider, which might cost about $200. It depends on my age and such, but it's going to be a very low cost. And why I would do that is to prevent a modified endowment contract or a taxable event. And then third, I would put the rest toward the PUA rider. And this is what will result in me seeing the most in cash value. Now that PUA rider is also flexible, meaning you could set it up where you're only billed for the minimum of $2,200 and then you can add everything else at your discretion. Here we've got a video that walks through the actual design of a policy where I go through different splits and such in the insurance company software. So the follow-up question that always pops up that I would ask if I'm new to this is, how low can the base premium be set? And the answer is, it depends on the life insurance company. But if your goal is to get as much cash value as possible, what I would do is simply set that base premium as low as the insurance company will allow, and that will result in getting the most cash value. Before I started IBC Global, I had worked as a case designer at an executive benefits planning firm. What that means is I got to model the whole life insurance policies that we set up for corporations. And the corporation's goal was always maximizing the cash value as an asset on the balance sheet up front and also long term. The design approach that always produced the highest results was this approach. So we're copying the corporate model in this particular case. Now, all companies do have specific rules. If we look at your four major mutual companies, which are Mass Mutual, Guardian, New York Life, and Northwestern Mutual, we can often drive that base premium as low as 10% of the total payment. So of that $20K, that's where we come up with the $2,000 minimum. All right, starting a policy with a lump sum. Not all companies will allow you to do this. There are several. Here are three, just to provide some examples. We have Guardian, who is one of the four major mutual companies. And then we also have Lafayette Life and Security Mutual, who will allow it. These are two companies that offer whole life insurance with a specific focus on the cash value as well. In this video, we will focus on Guardian, as I do prefer the major mutual companies for several reasons. So Guardian's specific rules are as follows. In the first year, they'll allow a PUA deposit of up to 50 times the base premium, or 50x. So what that means is that the maximum PUA that we can throw into a policy is 50x in the first year, and then beginning the second year, the most we can illustrate is 10x the base premium, and this is only if we have what is called a 1-year term insurance rider attached, which you'll see on the illustrations that we'll go through. So what we'll look at is designing a policy with and without a lump sum. We'll start without a lump sum so you can see the underlying design of the policy, and then we'll look at the same policy, but we'll add a lump sum on top of it. So the example without a lump sum, we're going to look at a funding amount of $20,000 per year. We'll fund it for 10 years to keep it simple. That's a total of $200,000. And we'll look at three examples. First, we'll look at a 100% base premium, which means your full $20,000 payment is going toward the base premium. Then a 50-50 split, which means $10,000 is directed toward the base and $10,000 toward the paid up additions rider. And then a 10-90 split, which means 10% is directed toward the base, or $2,000, and then 90% or $18,000 is directed toward the PUA. It's actually about 17.8 as a small percentage of the PUA is directed toward the term insurance rider. So we'll look at that, and then we'll look at the same thing, but with that additional lump sum deposit of $100,000, which will all go into a PUA payment. So let's start with the examples without a lump sum, shall we? So the first one, this is the 100% base premium design. So here we see $20K per year going in. Up top is your base premium. First year cash value is not quite a zero, but very, very close. $700 is what you have in cash value of your total $20,000 payment. And then by the 10th year, you've paid in a total of $200 and you have $192. You break even in year 11. Next, we've got the 50-50 design, which you'll notice is the exact same product with the exact same company. Same out of pocket, $20K per year for 10 years. The difference up here is your base premium of $10,000. And then down here is your PUA payment of $10,000 for the same total of $20,000. Here's your cash value in the first year. Instead of $700, you have $10,000. Much more attractive. This policy does not have a term insurance rider because it does not need one. However, we are very close to the MEC limit in this example. And then lastly, we'll look at the 1090 design. So here we go. He's funding $20K per year for 10 years. Up here is his base premium. Look at the first year cash value. $17,000 and change. Why that is so much higher is because of his $20,000 payment, only $2,000 went toward the base. Then we have the PUA payment of $18K, which, to be fair, the term rider is peeled out of that, and then the rest goes toward the PUA balance. But we're very cash rich up front, and he breaks even in the 4th year. Let's look at a side-by-side of these three. So what we'll start with is the 100% base premium example. So what you can see here on the left, you've got your base of 20K, nothing going toward PUAs, and a net annual outlay of 20K per year. There's the cash value, death benefit, and the CV growth represents the cash value growth. This simply shows how much money you are getting from the insurance company year over year. Let's compare this with the 50/50 design. So here, same company, same product, same 20K per year. The difference is your red column is cut in half. It's $10,000. Then your PUA column is $10,000 in purple. So same out of pocket. And what do you notice about the cash value? We've got more. What's highlighted in yellow represents your break-even point, which is the first year your cash value is equal to or greater than your total payments. So you break even in 7 to 8 years instead of 11 years with the 100% base premium example. Let's look at the 1090 design. Here we go. Exact same product with the exact same company. 20K per year going in. There we go. After the 10th year, no more payments. Break even point. Year 4 instead of year 7 or 8 or year 11 with the 100% base premium example. So this sets the foundation for the example we're going to look at next with the $100,000 lump sum. Now, when we look at the $100,000 lump sum example, it requires a larger term insurance rider. So you'll see the exact same design in terms of $20,000 per year going in, the same base premium ratio, but we will see a larger term insurance rider because that is needed in order to prevent a modified endowment contract from occurring. So let's take a look. We'll start with the exact same 100% base premium example. What we have here is a policy, it's the same exact product with a $20,000 base premium. What do you notice that's different about this policy? The first year deposit is $120,000 because he's paying 20 plus the desired 100K lump sum. The death benefit, however, is substantially higher. The reason why is because we've added term insurance to the policy in order to prevent that modified endowment contract from occurring. So, as we look at the numbers, he pays in $120 in the first year and then $20 per year thereafter. The second year is a little bit higher than 20 because the illustration is assuming that he's also covering the cost of the 1-year term insurance rider cost. But after that, $20K per year pays in a total of about $300,000. Next, let's take a look at the 50/50 design. Same company, same product, same out-of-pocket to him. $120 in year 1, $20K per year thereafter. Up here is his base premium. Here's his ongoing PUA. So add those two together. That's your 50/50 split. And then you have the lump sum on top of that of $100,000. First year cash value, just about 107. So very cash rich, which is nice. And then lastly, we've got the 1090. Now to be fair, this is closer to about a 12.5% base premium, not a 10% base premium. The reason why is because with these designs, I did have to slightly increase the base from $2,000 to $2,500. The main reason why is because if you take a $2,000 base premium, you may recall Guardian's limits that we covered earlier in the video. The maximum we can illustrate in the first year is 50x that. 2,000 times 50 is 100,000. Our first year total deposit is 120, so I had to increase the base a little bit. I could have made it 2,400, but 2,500 was a cleaner number. That's why I made it that. So here we go. A $2,500 base premium. Term insurance costs, you've got 2 term riders here, but then the rest is going into PUAs, and there's your lump sum PUA payment. Okay. First year, 120 goes in. You've got about $114,000 in cash value. That is just about 95% when we look at it. For example, if you wanted to get the percentage, what you could do is take that first year cash value of $113,968 and divide it by the first year payment of $120, and there you go, 94.97%. I'm going to round up and call it 95%. Okay, let's take a look at the side-by-side comparison of these. So, what we have, firstly, the all base premium example. $20,000 base premium, no ongoing PUA payment, but a lump sum up front of $100K. In dark blue is your annual outlay. Then you've got total outlay, cash value, death benefit, and the cash value growth, which is meant to display the cash efficiency of the policy. That lump sum really helps, doesn't it? Look at your break-even point. Without the lump sum, it was year 11. With, it's between years 6 and 7. That just demonstrates the fact that adding money into PUAs is going to accelerate the cash value growth of a policy. Then we've got the 50-50 design. Here we go. 10K base, 10K PUA, 100K PUA lump sum. There's your annual outlay. Break even, so close to year 4, positive in year 5. When we look at this long term, which one has more money? The example with the lower base premium. Now, let's stretch this guy to the limit and look at the 1090 design. So what we have here, a $2,500 base premium, $17,500 PUA, and a $100K lump sum PUA payment. Your total annual outlay, exactly the same as the last 2 examples. There's your total outlay. Look at the first year cash value and break-even point. You're almost made whole by the end of year 2, and by the end of year 3, you are cash positive. What do you notice about the death benefit on all 3 of these examples? They're exactly the same. Why? Because we need a $2.5 million death benefit for a $120,000 MEC limit. Because $120,000 is the total first year deposit, doesn't matter about the split because we have the same dollar amount going in. When we look at the long-term cash value, which one has the most? The example with that 10% minimum premium. You'll typically see that to be the case. So the main purpose of this demonstration is to show that we can have a minimum base premium with a 1090 split or very, very close to it and add a lump sum on top of that. It does depend on the specific insurance company, but it is possible. And what I've seen a lot of people like about this is that they can commit to a very, very small amount and pour in extra funds at their discretion. So for example, if this is you, you're committed to the base premium plus the cost of the term, so call it $3,000 or $3,500 per year, and then everything else can be added 100% at your discretion. Guardian's very flexible. We can log into a portal and just throw extra money in, and you're not required to either. But if you don't, it will impact the values of the policy. So let's wrap up just with a few additional points that are beneficial to go over. Firstly, how to measure the efficiency of a policy. There are some things I would not look at, and there are some things I would look at. What I would not look at is the dividend interest rate. Why I would not look at the dividend rate is because the dividend interest rate is a gross rate that is applied to the cash value after the cost of the life insurance. the dividend rate will never show what your cash value is actually growing by on a year-to-year basis. Then we've got your annual yield or annual rate of return. I would look at this. Now you can request this from most agents and insurance companies. Additional reports can be added to most life insurance illustrations that will show this, the annual rate of return. Some companies will use annual yield. For example, if we look at bank-owned life insurance, which is products banks purchase, you will see the term annual yield on the illustration with some life insurance companies. It's meant to show the net yearly growth rate, not the gross. So these are beneficial to look at. If someone asks you, what was the rate of return on your cash value last year? The annual yield or rate of return will answer that question. And if you wanted more of the average growth rate, then I would request the internal rate of return, or IRR. This provides more of the lifetime average. However, you can request this from any life insurance company, as a box can be checked that will show this. Let's take a look. So how we can show these on an illustration, I should say on Excel, is as follows. What we've got here is the 1090 split, and we actually have two different versions of it. On the left is the one we focused on, so this was in the demonstration. And then on the right is an example of the same product, just with a PUA rider structure that gives us a bit more long-term potential. It has higher PUA fees, which takes more money up front, but you will see more cash value long-term as a result with the exact same company and product. So long-term PUA. All right, let's start with the annual rate of return. What we can do here is pull it directly from the insurance company software, or if you're good at Excel, you could just drop it in. Pretty cool, right? So this is with Guardian. The dividend rate is currently 6.10%. Do you ever see your actual net yearly return hit that dividend rate? No. What about the other product? Peaks at very close to 5.25% when we look at the year-to-year growth rate. Now, that is a safe growth rate, and it's also tax-free, provided we follow IRS rules and such. That's where people are attracted to it, especially when you combine that with the fact that you can borrow against it. But that's how we can calculate the returns. You can get this on the PDFs with most life insurance companies as well, if you'd like to see it on their material. Let's go back to our Word document and talk about measuring the cash value growth, which is the same thing as efficiency, but we're looking at it in dollars in terms of rate. So what I would always ask for here is to see the growth of your policy without your payments included. This is so important. For example, you start a new policy and have zero in cash value. You make your first payment of $10,000. It's designed for maximum cash value, and let's say your first year cash value is $9,000. The illustration will often show and state that your cash value grew by $9,000 because it was zero and now it's $9,000. I don't really like that type of explanation. The reason why is because it's really a loss of $1,000. I paid 10 grand, I have 9 grand, which means I lost 1,000. Yes, I'm getting the life insurance benefit as well, but for someone who's very, very focused on the cash value, they're going to point this out. So we always find it beneficial to point it out for them so they don't have to invest a ton of mental energy to try and figure out something that is as confusing enough as things are. So what you can ask for here is the net cash value growth, meaning you want to see the growth without your payment being accounted for. So here's what we can look for. In the same Excel workbook, CV growth, what I would do is take the first year cash value equals cash value minus annual outlay. First year, you paid in 120, you have about 114, that's a $6,000 loss. Let's look at the next year. What do we do here? Well, we would take equals year 2 cash value minus the year 1 cash value. Do you stop there and hit enter? because your cash value was 113 and change. Now it's 138 and change. If you ask some agents and look at illustrations from some life insurance companies, it'll show $24,000 in cash value growth, which is fantastic. It's not how it works. We also have to back out our payment. This will show us exactly how much we received from the insurance company. So it's the year 2 cash value minus the year 1 cash value minus our payment. Now I can see exactly what I received from the life insurance company this specific year. And then we can just drag that all the way down. And then we can copy and paste that formula with any company or with any illustration. But that often is an efficient way to look at the cash value growth in a life insurance policy. All right, last item I want to hit on. With a whole life insurance policy, especially if you're funding it with a lump sum, more cash value means more opportunity. So what I would encourage everyone to do is don't fall for the every situation is unique as an excuse to accept a higher base premium. When you look at life insurance policies, particularly if cash value is your goal, a higher base premium means that you, the policyholder, are giving money up and the agent is making more money. No matter what someone's opinions are or thoughts are on that statement, it's true. That's how it works. The base premium is the number one driver of agent compensation with all life insurance companies. Now, when you look at lowering the base premium, what this means is you will have more money in cash value. This is also the approach corporations take when cash value is the goal. If you're working with anyone or multiple agents and you're trying to see a design that works for you and you're not getting that, I would ask to see a comparison with multiple life insurance companies and products. It's okay to ask. It's your money. Sometimes people get nervous, which I get because a lot of times we work with an agent and the agent works really hard to produce different results and we don't want to feel like we keep on asking them. Think of it if it was you. If you were trying to design a policy for someone and they had questions about it, would you want them to just move forward before you answered their questions? No, that wouldn't be fair. You'd want them to feel good about their purchase that they're making with you. Therefore, we want to dig into the details and provide answers to questions, provide the additional illustrations so they feel comfortable. The same should be done for you or anyone. Now, if you can't get what you're looking for from your agent, it is okay to speak with other agents and companies. Some people do that naturally, but just again, remember that this is your money. And if you want a third-party opinion from someone who is not incentivized to sell you a policy, you can also find fee-only actuaries out there that understand the specific rules of product design, MEC limitations, all of that important stuff that can simply say, here's exactly what I would do based on the dollar amount of money you're paying into the policy to maximize your cash value short-term and long-term. If you'd like a reference, I think Scott Witt is great. We've had some podcasts with him. Full disclosure, we've never had any type of financial relationship, and we do not intend to. We refer people to him simply because he does the right thing for clients and understands whole life insurance. I like his style. The name of his company is Witt Actuarial Services. So with all of that said, to go back to the question, can I have a policy where I fund $20,000 per year with a 10% premium, a 90% PUA, and add a lump sum of $100,000? The answer is yes. If you'd like to learn more about whole life insurance and how to get the most cash value possible, you can check out our guide that goes over the 3 things to know when getting a whole life insurance policy for cash value. We cover policy design and a lot more. If you have any questions, thoughts, or comments, please feel free to leave them below, or you can DM me as well. And as always, I hope this helps.